Hey, how are you? Hope all of you are well. It's your CPA Manish here today on Friday. Um, we are going to start a short mini series on pension planning strategy for all. And this is the first video in that series. And in this series, we are going to discuss the various pension planning opportunities and the various pension plans that we can use for our financial planning. There are a lot of pension plans. We would be discussing approximately around 10 or 11 of those in this series. Just to make it easy, I'm going to divide all these plans into various categories. What are the pension plans as employees? What are the pension plans for employers? Under employer, what are the pension plans for small businesses, self-employed individuals? Within that, we'll discuss pension plans that are available if you have employees. There are pension plans which are available if you do not have employees. And finally, we will also discuss pension plans if you want to do very high number, very high amount in pension planning every year. So in next 3 or 4 videos, we are going to discuss everything about pension planning. I hope this helps. I hope you enjoy this series. Before we get into these details today, I want to first of all familiarize you with few terminology that is used in pension plan, or I want to clarify some things which are misunderstood when it comes to pension planning and things like that. So I want to talk to you about 4 things today. First of all, it is not necessary that pension planning is a tax saving tool. It is not necessary that pension planning is a tax saving tool. Most of the times, many of the times, it is a tax deferral tool. It's a tax deferral tool. You do not pay tax today when you fund your pension, but then you have to pay taxes when you withdraw your pension money in your retirement. So you do not pay taxes today because you're putting money into pension, but when you withdraw the money in your retirement, at that time you have to pay taxes. So you're not saving taxes really, you are deferring taxes. So not always pension plan is for tax saving. Many times, most of the times, is for deferring taxes. Now the question is, if it is tax deferral, then why do people do pension planning? So people do pension planning for various reasons. One of the reasons could be that you are in a very high tax bracket today, and you anticipate that when you retire, in your retirement, you might not be in such a high tax bracket. So if you anticipate that today you are in a very high tax bracket, but when you retire, in retirement, you might not have so many taxes to pay, so much high of a tax bracket, then pension planning is something that you would consider, so that today you will save high taxes. And in future, in retirement, even if you have to pay taxes, those will be lower rate of taxes. So that is one reason why you might want to do pension planning. If you anticipate your bracket is high today, but will not be as high in retirement. The second advantage of pension planning is the compounding effect. It's the time value of money. It's the compounding effect, because if you get to invest the whole dollar without paying taxes, without reducing that dollar because of taxes, if you can invest the whole dollar, and that complete full whole dollar, if it is growing year after year for next so many years, for next 20 years, 30 years, 35 years, then the growth, the compounding effect of the income that you will get on this full dollar is much higher compared to if from that dollar, if you have to pay taxes and then you have less to invest. So there is time value of money, which is real. The compounding effect is real. If you have more money to invest today, and then that more money grows over 20, 25, 30, 35 years, then you will have a lot of money compounded, a lot of money accrued and added in your retirement, compared to if you have to pay taxes today and then you are left with less money to invest. So that is another reason pension planning is a good tool and people do consider doing pension plan. One more factor that you should consider is, where do you plan to retire? If you plan to retire in a tax-free state, if you plan to retire in Florida or Texas, then by doing pension planning, today you are saving the state taxes, whatever they might be. The state taxes might be 8%, 7%. If you're in a higher bracket and you're in New York, it could be 10%. And then if you're in New York City, you have to add another 3 or 4% to that. So your state taxes itself could be a liability of anywhere between 7% to all the way 13 or 14%. If you're in California, it's even higher, right? So if you are saving more state taxes today by doing pension planning, and if you plan to retire in a tax-free state and you won't have to pay state taxes when you withdraw your money in your retirement in a tax-free state, that is another 10 to 13% that you can save, in addition to the compounding effect of so many years, right? So these are the reasons why you might want to consider pension planning. If you plan to retire in a tax-free state to get the benefit of compounding interest, compounding returns, and then if you anticipate that you're in a higher tax bracket today and you might be in a lower tax bracket in retirement. If you anticipate reverse in the sense, if you anticipate that you are in a lower bracket today, but you might end up in a higher bracket in retirement. Let this sink for a couple of seconds. If you think you're in a lower bracket today, but you might end up in a higher bracket in retirement, then also you want to do pension planning, but that pension planning is not a traditional pension planning. That kind of pension planning is called Roth pensions, Roth pension planning. Roth pension planning is something where you do not get the deduction today. In Roth plans, you do not get a deduction today. But then whatever money you put into Roth and whatever it grows over the next 20, 30 years, and whatever the total is accumulated, compounded, accrued at the end in retirement, the huge number, and you start withdrawing that from the Roth accounts, this whole money, this huge number that you withdraw, you can withdraw all these at that time without paying any taxes. So Roth is reverse. Traditional pension accounts are where you get deduction today, but you have to pay taxes when you withdraw in retirement. Roth is reverse. You do not get a deduction today. You do not get a deduction today, but then whatever it grows to and you start withdrawing in retirement, all those withdrawals also, you do not have to pay taxes on those at that time. So if you anticipate that you are in a lower bracket today, then you don't need a deduction. You don't want to take a deduction. Do Roth pension funding. And then if you anticipate you will be in a higher tax bracket in retirement, at that time, if you withdraw from Roth, you do not have to pay any taxes. So at that time, you will save higher taxes. So this is the second concept I want you to understand. Traditional pension plans are where you get a deduction today, but you have to pay taxes in retirement. This works for people if you're in a higher bracket today, but you will be in a lower bracket in retirement. But if you think you are in a lower bracket today, but you will be in a higher bracket in retirement, then you want to reverse your game. You want to do Roth pension fundings. You do not need the deduction today, but then in Roth, you do not have to pay taxes when you are in a highest bracket in retirement. So if you need to listen to this a couple of times again, please do so. But that's the difference between traditional and Roth. And that is where the traditional and Roth come into picture. How to decide whether you want to do traditional or you want to do Roth. It depends upon your anticipation. If you think you're in a higher bracket today or you will be in a higher bracket in retirement, that decides whether Roth is better for you or whether traditional is better for you. The third thing I want to bring to your attention is, if you put money in your pension plans, most of the pension plans, you cannot withdraw the money before you are 59 and a half years old. There are exceptions, but in most of the plans, you cannot withdraw the money before you are 59 and a half years old. If you withdraw before you are 59 and a half years old, then you will attract 10% pre-withdrawal penalty. Again, there are exceptions. I'm just giving you an idea. Try not to withdraw money from pension accounts before you're 59 and a half. You might attract an additional 10% pre-withdrawal penalty, okay? And then there is a concept in pension planning, which is called as a match. It is matching concept, okay? What is matching concept? As an employee or as an employer, matching means that the employer will contribute towards an employee's pension plan only if and only for those employees who contribute to the pension plan themselves. Matching, as the word means, is the employer will put money into only those employees' pension plans if that employee contributes towards the pension. So where the employee contributes, the employer contributes. That's the match. If the employee doesn't contribute, the employer doesn't contribute. So match is simple. Employee contributes, then the employer also contributes. The employee doesn't contribute, the employer doesn't contribute. So that is the matching concept. So not all pension plans have match feature, but in next few videos, when we discuss various pension plans, I'm going to talk about matching concepts. So I need you to know this. So what we discuss in today's video is four things. Number one, pension plan is not always tax saving. It is tax deferral, but still people do it because they can save state taxes if they move out in a tax-free state. They do it because they get compounding effect on the earnings. So that helps time value of money. And they do this when they think they are in a higher bracket today, but they will be in a lower bracket in retirement. But if it is reverse, they think they are in a lower bracket today, but they will be in a higher bracket in retirement. They might as well think about having a Roth feature, doing the Roth pension planning. The third thing that we discussed is if you withdraw before you're 59 and a half, you might attract 10% penalty. Be careful of that. And the last feature we discussed was matching concept. Matching is where if the employee contributes, the employer contributes. For the employees who do not contribute, the employer doesn't contribute. That's the matching concept. So I'm going to leave you with this today. And in next 2 or 3 videos, we'll discuss the various pension plans. I'm planning to go over approximately 10 to 11 plans. And that's why I'm going to do it in small bites so that we get time to learn, understand, and digest. Okay. I hope this helps. I'll see you soon in the next video. Take care. Bye-bye.